The middle class isn't collapsing loudly. There's no crash, no sirens, no breaking news banner, just a quiet shift in gravity, a slow redistribution of stability. And most people won't realize it until the floor feels different beneath their feet. So the real question is, was this decline accidental or engineered by design? You feel it already. Groceries cost more, but your salary didn't move at the same speed. Rent rises with the market. Housing prices float beyond reason. A modest home now requires a near-perfect credit profile, dual incomes, and a tolerance for 30 years of leverage. Meanwhile, markets hit new highs. Tech stocks surge on AI narratives. Venture capital flows like it's 1999 again. Luxury brands report record demand. Private jets have waiting lists. Asset prices inflate as if prosperity is universal, but it doesn't feel universal. It feels selective. You're told unemployment is low, inflation is cooling, GDP is expanding, and yet your purchasing power feels smaller. Savings don't stretch. Healthcare, education, insurance, everything essential compounds upward. And debt. Debt is normalized. Auto loans, buy now, pay later, credit cards carrying balances at double-digit interest, mortgages structured to maximize affordability today and obligation tomorrow. You're not broke, you're squeezed, and that pressure is the signal, but here's what most people miss. The middle class isn't eroding because the system malfunctioned. It's eroding because the incentive structure rewards asset ownership, not wage labor. The modern financial system runs on credit expansion. Central banks inject liquidity to stabilize downturns. Governments stimulate demand to avoid recession. Financial markets respond to liquidity faster than wages ever could. When money becomes cheaper, assets rise first: stocks, real estate, private equity, venture capital. Not salaries. Those who own assets benefit from monetary easing. Those who rely primarily on income wait for trickle-down adjustments that rarely match the pace of asset inflation. This isn't a conspiracy, it's a transmission mechanism. Liquidity flows into financial markets because that's where leverage amplifies it. Corporations borrow cheaply to buy back shares, investors borrow to buy properties, funds lever up to chase returns. Meanwhile, the median household competes in a housing market shaped by institutional capital and ultra-low rates that lasted more than a decade. The system isn't broken, it's behaving exactly as designed. Its mandate is stability through growth. Growth is fueled by credit. Credit inflates assets. Assets disproportionately benefit owners. The middle class traditionally built wealth through home ownership, stable employment, and modest investment portfolios. But when housing becomes financialized and wages lag asset appreciation, the ladder stretches upward. Not removed, just extended beyond comfortable reach. But here's the twist. This dynamic accelerates during periods of technological transformation. Artificial intelligence, automation, digital platforms, these increase productivity. But productivity gains don't automatically distribute evenly. They concentrate in capital-intensive firms and intellectual property owners. Equity holders benefit first, labor negotiates later, and negotiation requires leverage. Now layer in fiscal deficits, sovereign debt expansion, and demographic shifts. Governments borrow heavily to maintain social stability. Interest rates fluctuate as policymakers attempt to balance inflation control with growth preservation. If rates stay low too long, asset bubbles form. If rates rise too fast, leverage cracks. There is no painless equilibrium. We've seen this movie before. In 2000, during the dot-com bubble, technology promised a new era, and it delivered, but valuations detached from cash flow reality. Liquidity met narrative. Speculation followed. When confidence faltered, the Nasdaq collapsed nearly 80%. In 2008, housing was considered safe. Mortgage-backed securities were engineered to distribute risk. Credit expanded aggressively. Homeownership became an ideological pillar. When leverage unwound, the global financial system nearly seized. In the 1970s, inflation eroded purchasing power silently before it erupted visibly. Wage gains lagged price increases. Confidence in monetary stability wavered. policy responses oscillated between stimulus and restraint. Different decades, same pattern. Excess liquidity, asset appreciation, narrative reinforcement, confidence peak, correction. Not apocalypse. Recalibration. And every time, the middle class absorbs the adjustment. Why? Because they are positioned between capital and policy. Too invested to disengage. Not insulated enough to be protected. But here, where it becomes uncomfortable. The erosion of the middle class rarely feels catastrophic, it feels incremental. A smaller home than your parents had. Later retirement. Delayed children. Side hustles normalized. 2 incomes required for what one used to sustain. Each compromise rationalized, each step is framed as adaptation. And adaptation disguises decline, but let's escalate this logically. What happens if confidence weakens while asset valuations remain historically elevated? What happens if liquidity tightens further because inflation resurfaces or debt servicing costs overwhelm fiscal flexibility? What happens if AI-driven productivity reduces certain white-collar job demand faster than new categories emerge? If credit contracts, leveraged positions unwind, if narratives break, speculative capital retreats, if unemployment rises even modestly, consumption slows, if consumption slows, corporate earnings adjust, and markets price forward, not backward. None of this requires catastrophe. It requires only fragility. The system functions on confidence. Banks lend because they believe borrowers can repay. Investors allocate capital because they believe future cash flows justify present valuations. Consumers spend because they believe tomorrow will be stable. Confidence is invisible until it is. But here, another twist. Even during corrections, asset holders recover faster than wage earners. After 2008, equity markets eventually surged to new highs, real estate rebounded in many regions, corporate profits reached record levels. But median wage growth remained uneven. Household wealth inequality widened. The recovery favored those already positioned within asset ownership structures. That's the silent asymmetry, and psychologically this dynamic is powerful. Smart people participate in bubbles not because they're foolish but because sitting out feels riskier than joining. If everyone around you builds wealth through rising markets, staying conservative feels like falling behind. If housing prices rise 15% annually, waiting feels irrational. If tech stocks double, caution feels obsolete. If AI promises exponential gains, skepticism feels outdated. Her behavior isn't stupidity, it's social survival logic. Now look at the middle class through that lens. They chase appreciation because income growth alone won't close the gap. They take on leverage because asset inflation punishes patience. They normalize debt because the alternative is perceived stagnation. And the system quietly reinforces this behavior. Low introductory rates, marketing narratives, policy backstops, financial media celebrating record highs. It feels safe. Until it doesn't. But the deeper issue isn't volatility, it's structural drift. When wealth compounds primarily through capital ownership, and capital ownership becomes increasingly concentrated, social mobility slows. Not stopping. Slow. That slowdown is subtle. Fewer people can buy into appreciating neighborhoods. Fewer families can accumulate multi-generational assets. Retirement depends more on market performance than pension guarantees. Security becomes market dependent. And markets are cyclical. Here's the uncomfortable mirror. Do you measure your progress by rising asset prices or by rising real stability? Do you equate market highs with economic health? If your cost of living rises faster than your income but your portfolio is up, are you truly advancing or compensating? These are not rhetorical for effect, they are structural. Because the middle class collapse, if it occurs, won't look like poverty. It will look like volatility layered onto obligation. High debt, high asset exposure, thin liquidity buffers, one shock away from contraction. Again, not inevitable, but plausible. And cycles don't require villains, they require incentives. Policymakers aim to avoid recessions. Investors aim to maximize returns. Corporations aim to increase shareholder value, households aim to preserve lifestyle. Individually rational decisions can collectively create fragility. That is systemic risk. The silent part isn't the data, it's the interpretation. Rising inequality statistics are abstract, debt to GDP ratios sound technical, liquidity injections feel distant. But the lived experience has smaller margins, larger risks, longer horizons that's tangible. And here's the final tension. If technological acceleration continues, capital may become even more dominant relative to labor. If geopolitical instability pressures supply chains, costs may remain structurally elevated. If public debt constrains fiscal flexibility, policy responses may grow more reactive. In that environment, the middle class doesn't disappear overnight. It stretches. Some move upward into asset-heavy strata. Some drift downward under leverage stress. The center thing. Quietly, but awareness changes positioning. Understanding incentive structures changes how you interpret headlines. Recognizing credit cycles alters how you view market euphoria. Identifying narrative bubbles protects you from emotional contagion. You don't need to predict collapse. You need to recognize patterns. Because the most dangerous phase of any cycle is the one that feels normal. The silent collapse of the middle class may not announce itself with a crash. It may arrive as a gradual acceptance of less security, more exposure, and higher dependence on markets behaving perfectly. And markets never behave perfectly. They oscillate. The question isn't whether cycles exist. It's whether you see them forming before they crest. If you want to understand the architecture of the system before it moves, not after it adjusts, subscribe. Not for predictions, for pattern recognition. Now I'm curious. Do you think this cycle resolves through slow adaptation or through a sharp confidence reset? And more importantly, where do you believe the middle class stands when the next liquidity shift begins?